Okay. Good afternoon, everybody. Good afternoon from Athens, from IENE offices. I wish to welcome our speakers and panelists in this very important meeting on ESG criteria and green bonds. I am very positively surprised that we have a massive audience, by analogy. More than 200 people have registered already, and we have more, I cannot tell you right now, but we have a lot more through live streaming. So it means that interest on ESG and green bonds is fairly strong in our region. Of course, this is a fairly new area of engagement, and it links very well with the latest initiatives related to energy transition. So energy transition, of course, is the backbone of all this activity. And we decided as an institute, as we're following very closely developments in this area, to organize a special meeting to gauge the situation, the interest in this area, not only from Greece, but also from other countries. So in this respect, I'm very happy that our colleagues from Israel are joining us, also from the UK. And I understand that Sean Kidney, who is the head of the Climate Bond Initiative, is somewhere in the Far East, I understand, in Australia. So you see, we have an international audience. And that's why we have decided to have this entire workshop in English. Initially, the idea was to do a hybrid workshop, but the situation with coronavirus does not enable us to do this. But nevertheless, I think with the help of technology, we have managed to get everybody together. So I will waste no more time, but to say just a few introductory words about ESG. And then I will hand over the floor to our very distinguished and very well positioned and informed speakers. Now, ESG, as the name implies, that is environmental, social, and governance, is something that has been developing over the last 10 years, as far as I can remember. So investing has grown rapidly over the last years, and the amount of professionally managed portfolios that have integrated key elements of ESG assessments exceed, according to some estimates, $1.8 trillion. So we see that there is a very, very widespread interest. The growing investor interest in ESG factors reflects the view that environment, social, and corporate governance issues, including risks and opportunities, can affect long-term performance of issuers and should therefore be given appropriate consideration in investment decisions. And some of the original investors 5, 6, 8 years ago who started investing with ESG criteria have started seeing the fruits of their insight and investment, because their companies are have differentiated to a large extent their activities, and they have added value which they can sell either in terms of the share in the marketplace or in obtaining financing or attracting the right sort of people to work with them and so forth. So it is already working. It's not a theoretical mechanism, the ESG. It's very practical. There are 3 factors concerning ESG investment, which I'm sure most of you know, but nevertheless, I think at the start of this meeting, we should remind. First, recent industry and academic studies suggest that ESG investing can, under certain conditions, help improve risk management and lead to returns that are not inferior to returns from traditional financial investments. And despite the recent studies, there is growing awareness of the complexity of measuring ESG performance. So to be able to measure ESG performance is very important, and we'll come to that when we talk about the indices. The second factor has to do with the growing societal attention to the risks from climate change and the benefits of globally accepted standards of responsible business conduct. The need for diversity in the workplace and on boards suggests that societal values will increasingly influence investor and consumer choices and can impact corporate performance. And the third factor, which we should have in mind, is that there is growing momentum for corporations and financial institutions to move away from short-term perspectives and risks and returns so as to better reflect longer-term sustainability in investment performance. Now, this is rather complex as a statement, but I'm sure that people are already involved in ESG can understand very well this momentum and the sustainability in investment performance. May I also mention that ESG investing has also recently generated interest from the public sector, including central banks that have expressed support for ways to help transition financial systems towards greener, low-carbon economies. And lately, we have sovereign interest, that is from governments, to borrow or invest according to ESG criteria. Finally, in light of growing demand, the finance industry is creating more products and services related to ESG ratings, indices, and funds. Firms calling themselves ESG rating providers have multiplied. The number of ESG indices, equity and fixed income funds, and ETFs are now in many hundreds and are continuing to expand. Investors can now engage in ESG investing through low-risk products such as money market funds, passive small beta ETFs, and can even take positions through hedge funds that combine sophisticated synthetic strategies with ESG alpha investing. Investors seeking to position themselves for a transition to low carbon economy can invest in green transition and renewable funds. Now, I talked about indices and how important they are in the ESG environment. And one such index is the ESG index that has been created by the Athens Exchange 2 years ago. And we are going to start our presentations with Mrs. Peggy Papastavrou from Hellenic Exchanges, who is in charge of such an index. So Peggy is going to explain to us the interest of Athens Exchange in developing this ESG index and how it is being used. So Peggy, you have the floor.
Thank you so much for the opportunity you give me to participate at your webinar at the same panel with such distinguished speakers and address to such a great audience about sustainability and the Athens Index, which has become one of the most pertinent topics across the world. Capital markets and the financial sector are embracing the integration of ESG factors into their business practices, as well as their respective corporate reporting requirements. As Mr. Stambolis mentioned, ESG assets under management amounted to 35 trillion in 2020, and are expected to exceed 50 trillion by 2025. In the absence of ESG disclosure, investors can miss important information on a company's operations, competitive positioning, and long-term strategy. This explains the growth in endorsements of the UN-backed Principles for Responsible Investments, known as PRI, which is in 2021 reached over 3,800 signatories and represents over 121 trillion US dollars in assets under management. This exactly highlights the shift taking place among investors who are progressively incorporating information on ESG performance in their analysis. Stock exchanges are leading the integration of sustainability by enhancing transparency and encouraging sustainable investment practices. They have joined forces through initiatives like the UN-backed Sustainable Stock Exchanges to promote good governance and disclosure on ESG among listed companies. The Athens Stock Exchange has been participating as a member in this initiative since 2018. It has also undertaken other initiatives. You may have heard about the Ethics ESG Reporting Guide. This was launched in 2019, based mainly on the SASB standards and the reporting frameworks like GRI. The guide aims to increase awareness on the importance of ESG transparency, reduce complexity by proposing concrete and practical ESG reporting guidelines for companies aligned with national and European regulations about disclosure. Ensure effective ESG disclosure by improving the quality, comparability, and availability of ESG data, and facilitate the information flow between companies, investors, and other stakeholders. And also help investors incorporate relevant ESG data in their investment decision. The metrics used in the guide are categorized in core, advanced, and sectoral. The guide can be used not only by listed companies, but also by non-listed companies of all sizes and across all sectors. We have just updated our guide, taking into account the recently published standards, and we will publish it in the next weeks. You may have heard, of course, of another initiative that we carry out through our academy, and it relates to a specialized training course on ESG issues addressed to C-suite level executive. This course wants to enable board members and top executives of Greek companies to acquire the necessary knowledge to effectively manage the relevant ESG issues for their businesses. Now we come to the Ethics Esg Index. In 2020, we, together with the Hellenic Fund and Asset Management Association, and in cooperation with the National and Kapodistrian University of Athens, conducted a survey based on the metrics of our guide, of the Ethics Guide, to measure the compliance of the ethics-listed companies with the ESG criteria. The main findings of the research were that there had been an improvement in the amount of ESG disclosures from 2018 to 2019 for listed companies in all sectors. The highest compliance regarded governance. Following the survey, Athens launched in August 2021 the Ethics ESG Index in order to monitor the stock market performance of ethics-listed companies which disclose ESG information adequately and according to the Ethics Reporting Guide. Such ESG information should be available on a yearly basis till end October at the latest through an array of channels, including corporate websites, annual reports, sustainability reports, and other forms of reporting. The evaluation of the degree of adoption by ethics-listed companies of the ESG criteria, so that can be included in the index, is conducted by the university based on the latter's own methodology. Eligible companies for inclusion in the index are only those listed on the ethics main market. not the alternative market, not the surveillance segment. Such companies should have a minimum free float greater than 15% and an ESG scoring greater than or equal to 0.30 upon the aforesaid methodology of ECPA, the university. Now, the selection process. Companies fulfilling the eligibility criteria are ranked in descending order based on their ESG scoring. And only the first 60 companies of the rank are included in the index composition. There is also a weight process. A methodology is adopted for determining the weight of each constituent in the total capitalization of the index, which takes account the capitalization of each company weighted with the product of the free float and the ESG score. We have also capping, so the maximum weight of each constituent is allowed up to 10% of the total capitalization of the index. Other key characteristic of this index, which is weight capitalization index, is that the maximum number of constituents amounts to 60. There is an annual review every November, and the start of calculation was on the 2nd of August of 2021. The initial composition of the index included 35 companies based on the disclosed data of 2019. The composition of the index was reviewed last November based on the data published by the ATHEX companies regarding fiscal year 2020 in their non-financial information. We were happy to see that the constituents increased from 35 to 48, showing thus the progress in ESG disclosure in the Greek capital market. Our ATHEX ESG Index offers the following advantages. Companies can gain a competitive edge. Inclusion in the index adds to their visibility and prestige in the investor community. Also, we believe it is an investable index on which new instruments can be developed in order to attract capital for companies. Indicatively, our index can be used as a benchmark for the performance of mutual funds, or an underlying instrument for the creation of an exchange-traded fund, the creation of a derivative, or a structured product. We further aim to develop the index methodology in cooperation with the university so that scoring can take into account not only disclosure, as it does now, but also the ESG performance on qualitative basis. We just remind the audience that our first attempt with the launch of this index was to sensitize our capital market, our listed companies in the ESG trend. So we will further develop. Another important initiative ATHEX has taken regards to the ATHEX bonds greennet. I hope you have heard about it. It regards sustainable bonds, ESG bonds. Sustainable finance through ESG bonds has grown rapidly in recent years, amounting to 1 trillion only in 2021. The International Capital Market Association and the Climate Bonds Initiative, CBI, have issued a range of voluntary sustainability reporting standards and guidelines, and serve as de facto gatekeepers to assess the eligibility of ESG bonds. As the use of sustainable debt instrument increases, more stock exchanges are developing initiatives to enhance the visibility of such issuance to the investors to foster sustainable finance. To this aim, ATHEX launched this January a special information hub on its website named ATHEX Bonds greennet, where all eligible green, social, sustainability, and sustainability-linked bonds, which are listed on the ATHEX bond markets, the main market or the alternative market, are displayed, together with all the relevant ESG information material about each bond issue. We clarify that this green net is not a trading venue, is not a market, is not a trading segment. It serves exclusively the purposes of displaying issuers' publicly available documents associated with ESG bonds, such as the prospectus, the ESG framework, and the sustainability reports of the eligible bonds. This greennet, this information hub, offers the following advantages. Facilitates issuers of ESG bonds to increase their visibility in the investment community. Provides access to investors to centralized and easily comparable information that comes directly from issuers. Enhances ecosystems awareness on the ESG trend towards a sustainable Greek economy. Eligible bonds have to fulfill the following prerequisites for their inclusion in the greennet hub. Publication of an issuer's announcement with the basic characteristic of the bond issuance and the issuer's commitment in accordance with the principles followed as referred to in their prospectus. External assurance by an independent auditor at the pre- and post-issuance stage of the bond. And finally, the issuer's commitment for provision of periodic and extraordinary ESG information in accordance with the principles followed throughout the lifetime of the bond. For the time being, there are 4 green bonds in the greennet displayed of Terna Energy, Noval Properties, and Prodea, and 1 sustainability-linked bond, that of YEK Terna. Another initiative we are going to undertake is that, taking into account that only a limited number of Greek-listed companies are ESG rated by international service providers, ATHEX wishes to create an ESG data platform in which ESG data of companies, listed companies and non-listed companies, will be gathered in order to serve as the main Greek ESG data repository so that it can increase quality and transparency of ESG standardized reporting. This platform will facilitate the ESG information flow to institutional investors in order to integrate non-financial factors within traditional investment and credit rating analysis decisions, as well as to comply with their obligations arising from the various EU regulations, such as the SFRDR and the upcoming Corporate Sustainability Reporting Directive, but also banks in order to take these ESG factors into consideration in the financing decision. I don't want to bother you anymore. As a closing note, ESG represents an important opportunity to put Greek businesses and the Greek capital markets in a position of leadership in the path to sustainable growth. The benefits for Greece could be enormous, placing the country in a favorable position ahead of large societal megatrends such as climate change, the impact of technology on jobs and human capital, and improving inclusion in the workforce and in business practices. Thank you for your attention.
Thank you very much, Ms. Papastavrou, for a very explicit explanation of the Athens Exchange's approach to ESG and the index. And could you please give us a first reaction as to the company's interest and response to ESG, apart from the ones that are already included in the index? What do you sense is the market interest concerning ESG? Is it strong? Is it waning? Is it indifferent? Where are we now?
The interest cannot be other than strong, because visibility is something that companies that are listed in exchange desire and seek, and the inclusion in an index always enhances visibility. So numbers speak for themselves. The fact that after one year, after some months of launch, we saw already the increase from 35 to 48 is a factor that shows such interest. And we still have everyday calls from our companies, how they can, what they have to do in order to be included also in the index. And that
I'm not clear about 45 to 48. What is this? You said it's the inclusion in the index?
In the initial, when the index was launched, only 35 were eligible according to the methodology of the university. Okay. But at the first review of the index that took place last November, we saw an increase in the eligible companies that were very active to disclose the necessary ESG information. And we saw an increase to 48. That's a very big increase.
Okay.
And from November till now, we see every day and we receive calls from our companies that want information how they can achieve their own inclusion till the cap of 60 is reached.
Okay, right. I suggest that we move to our next speaker, and then at the end of the, once all speakers from the first session have talked, then we have a more general discussion. So we now move to Mr. Spiros Venetianos from Eurobank. Eurobank is very active in the financial markets in Greece. And Spiros Venetianos is the Deputy General Manager of Eurobank. So, Spiros, you have the floor.
Thank you, Mr. Stambolis, and thanks for the very interesting invitation and subject that we are going to analyze today. I'm going to be relatively brief, as I would like to utilize more of your time answering questions. Nevertheless, I would like to give you the perspective of a bank. The situation in the banking system, and this applies for all Greek banks, has as follows.
Spiros, it's my omission, but I forgot to mention, because we have many viewers from outside Greece, that Eurobank is one of the main systemic banks in Greece, with a very, very positive track record over the last few years. So it's one of the major banks. So please go ahead.
Thank you very much for this one. Starting from an introvert view, as banking institutions, we are required at this moment to check that our investments do not significantly harm the environment or do not affect negatively social and other factors. Nevertheless, we are not yet positively motivated through capital requirements or capital restrictions in relation to where we allocate our portfolios. This is the requirement. Nevertheless, we are certain that this is not going to stay as it is for long. And that's why all the banks are looking into the future and try to prepare the next day. What is the next day? The next day is to focus on more green investments and more socially responsible investments and more environmentally sensitive investments. In this sense, all of us are trying, first of all, to educate internally the personnel of the banks. The main focus of the Eurobank last year was to train personnel for ESG and for digital transitions. This was the highest budget spent in the bank. So everybody is looking at this trajectory. How are we preparing and what we believe is going to happen in the future? First of all, we are assisting in the issuance of green bonds, but this is a market that others will speak more about. I would like to discuss more on loan financings and other products that the banks are looking to activate. The reason is the following. The top tier issuers are well educated, and the asset listed companies have departments that are focusing on ESG, on environment, a number of years. We need, nevertheless, to activate also the smaller companies, even if they are medium or large size, to think about the environment, think about the impact, and motivate them to think ESG-wise. This is very important because they have less publicity, they are less interested on their corporate image. Nevertheless, they are the core of the economy, not only in Greece, but in other European countries as well. In this trajectory, we try to do two things. First of all, establishing internally a framework on the basis of which we try to motivate green investments. And we separate green investments in two categories. The first one is very clear. For example, in energy, when we provide a loan for renewables, this is clearly a green investment. Of course, we need to respect a number of ESG factors. It doesn't mean that if it's a renewable, it's good for everyone. It needs to respect the environment, respect the communities around it. We have to be careful. Nevertheless, there are also investments like the investments that Hellenic Petroleum, Motor Oil, the big players are doing in order to improve their environmental footprint. And these are called sustainability-linked loan or investments because we provide capital in order to have some results that benefit the environment. This is helping a lot of people within the bank and clients to think about their business plans and how much they affect the environment. And in order to motivate in this trajectory, we are trying to have better financial terms for our clients that are focusing in these categories and in relevant products. For example, we have issued, probably it's irrelevant for our session today, a relevant product in the hospitality sector for hotels. We said that the hoteliers who are looking to improve their ESG footprint, they are going to get an improvement in existing financings as well as new financings that are utilized for greener investments and a better impact. This, of course, is not resolving the problem. This is actually trying to put something on the agenda for people. I think what is very promising for the problems is the RRF framework, is the Resilience and Restructuring Framework, which is the 11.7 billion fund that has been provided by EU. And one of the 5 pillars, it's the green transition. Green transition includes a lot of the energy, the renewable energy products, and it's actually providing funds in a very, very low margins. So I think this is another very interesting tool in order to support the ESG transition. I think that the agenda in the future will be wider. I think that in the future, we will be required as banks to invest less than in polluting businesses. and more in green businesses. Now we are doing that voluntarily, and we are doing that not only because we like the environment, but because in the back of our mind, we think that an investment that is respecting the environment has a better future. And if it has a better future, it has a lower risk. And bankers always think about risk. So your company is more relevant if the company thinks about the environment. So in this voluntary scheme is going in the near future to have bone and flesh, and we will be monitored in relation to what we are doing and how we are utilizing depositors' money in order to finance investments. That's from me, and I'm happy to answer any questions from the panel.
Thank you, Mr. Venetianos, for putting forward Eurobank's point of view with regard to ESG. But please tell me, as a quick question, are you applying yourselves as a bank ESG criteria when considering a big loan or considering an investment by the bank? What is the daily experience, if there is any, from using ESG?
Practically speaking, we have changed the systems of the bank a month ago in order to be able to report every new loan that we are providing, whether it meets certain ESG criteria. So as you understand, we are also in a transition period. We are trying to be practical. And of course, we were doing that on an ad hoc basis. Nevertheless, now we are trying to do it more systematically. As such, you know that when we are discussing a number of years that financing renewables was a top priority for the bank. This was both for the solid framework, but also because it supported a lot the green transition. This is only an example. Now, examples needs to be part of the system, and we need to monitor that in a global fashion.
Okay. Now, another question I have is, when you are considering giving a loan to a renewable investment, whether a photovoltaic plant or wind or a biomass, biogas, okay, this is straightforward, it's positive, it's good, but have you started applying more strict criteria using ESG in such very obvious investments?
We were always using a framework that has to do with checking the environmental licensing and using our own advisors for the due diligence in relation to the impact on the environment and the social communities.
Okay.
Even if we were doing that on our own risk assessment, now it's becoming part of the policy of the bank. So things that we were doing intentionally or unintentionally on an ad hoc basis, now they are becoming the system. And this is the trend everywhere.
Okay. I have no further questions. We can obviously discuss things at the end. May I now go to our next speaker, Mrs. Elena Athusaki, who is ESG Director, Sustainable Development and Climate Change at Motor Oil. Now, Motor Oil is one of Greece's leading energy and industry firms, established more than 50 years ago, very active in not only in oil and gas, but lately in renewables, but also very considerate when it comes to energy efficiency. And they have invested quite a lot of money lately over the last 10 years in improving the energy efficiency, not only of the refineries, but of the whole operation. So, Mrs. Athusaki, you have the floor.
Thank you very much. Thank you for the invitation. It is true that we do have our 50 years anniversary this year. And it is true that, there is a lot of pressure at the moment from the investors and from the banks in order to evaluate better the companies with regards to the ESG. And this is something we take into consideration for our 50 years anniversary. We actually embed it into our operations, of course, and our strategy as well. The truth, of course, is that one of the reasons that the banks and the rating agencies are sending us so many questionnaires is because of the sustainable finance directive and the regulation and the pressure that comes from the governments to the system, to the financiers, let's say, to be able to evaluate the companies based on the ESG criteria. And I think that that's one thing. And of course, the other thing is that somehow is becoming the climate risk as a credit risk. And therefore, the banks and the investors need to take this into account. Having said that, I think that it makes, we understand why there is so much pressure and rising demand from the investor to the oil and gas companies in particular, because we need to have this transition, the energy transition plan. In order, let's say, to completely change our business model and somehow showcase to their investors that the material improvements that we have made in terms of the ESG and sustainability. I think that from our side is that we don't see only this pressure. I think we've seen all the sort of positive things that we can actually get from embedding this ESG and sustainability strategy into our operations, drive the competitive advantage, to improve the risk management, to of course maximize the shareholder value, but on the other hand, to improve the digitization aspect, to foster innovation, and more with regards to the customers and our people, to have them more loyal to us. So I think these are some kind of elements that ESG criteria actually covers. I'm very happy to actually announce that our company recently has been awarded as one of the most sustainable companies in Greece. And I think that the success on this lies on three things. I think one, of course, is that we have embedded ESG and sustainability into our strategy operations, as I said before, but also in our culture, and which is not easy to do that, of course, because as you basically said, although the sustainability started many years ago. I think on the ESG side, and ESG part to become the ESG criteria, to become part of the culture of the people, is something new. So we have invested, as the previous speaker said, Mr. Venetianos, a lot in the training our people with regards to ESG principles and criteria. We have embedded ESG into our vision, mission, principles, our policies, our corporate governance, the procedures that we have, and moreover, I think in the decision-making process that we have. So I think that was one thing that we have changed. The second thing is that we are performing ESG impact assessment for every important project. And we look on the positive side and the negative side. And that means looking at the climate risk analysis, looking at the transition, the physical risk, followed by certain scenarios analysis, looking for different business case, but also looking on the operation, the market side, and the IRR. Looking at the maturity of the technology, for instance. So it's not only looking the market, the risk analysis, the climate risk analysis, but you need to look at with other aspects as well that can make your project, sustainable, fully sustainable. And I think the third thing is that we are started to have a very transparent and reliable ESG performance reporting. And I think this is something that the investors and the banks actually see it in a really nice way, because they're able, let's say, to evaluate the specific ESG criteria. So I think that what I'm trying to say is that sustainability is a key driver for us, and we have embedded in a short, medium, and long-term strategy. The values, the sustainability values and the ESG criteria, okay, I think that we try to follow all the latest trends. And I think we try to be in alignment with our, the policy agreements, the goals, the frameworks at a global level, which means UN Sustainable Development Goals, UN Global Compact, OECD, Paris Agreement, of course, and then at EU level. And at EU level nowadays, we have so many regulations, okay? Starting, let's say, with the European Green Deal program, and then going into Fit for 55, then have sustainable finance, which impacts us through the EU taxonomy and the eligible activities there, the CSRD that is coming, the new reporting standard. And so there are lots of new, let's say, regulation with Fuel EU, Refuel EU, that comes from the fuel side, which again, we see ESG becoming, let's say, part of every new legislation. And then, of course, apart from that, with regards to the sustainability, performance, and ESG reporting, we need to follow all of this international initiative, let's say, the GRI, the DCFD, the CDP, and all the independent assessment coming from the rating agencies. As you said, there are hundreds now. And we have to follow that because the investors are looking at these rating agencies, and therefore we have to be able, let's say, to reply to all this questionnaire, to be able to reply to the assessment reports that they have. Soon we were going to, as Motorola, to publish our long-term CO2 emission targets, and that is something that, again, it's as part of for sustainability strategy, and how we're going to be able to say to accomplish these targets. And these specific targets, as you can imagine, of course, we want to have a positive impact to the environment, the society, to the economy, but also we want to minimize the climate risk. And when it comes to the environment, our strategy, and I think there many times it's been said around, is basically focusing on energy efficiency, decarbonization, carbon capture, and digitalization. Okay, so digital transformation, as Mr. Svenziano said, is essential, and it goes hand in hand with climate change. We continue investing in e-mobility with new electric vehicle charging points and innovative technologies. What we want to launch in the future is the gas station of the future. We want to be able to have different energy products, sustainable buildings, smart systems, to include circularity in our gas stations of the future. We just want to create a new customer experience because the customer has changed. And the customers want to be able to see new services and products that they have ESG criteria embedded. So that is going to change our business model as well. Of course, as you said, we invest constantly in the renewable energy. We recently in the construction of floating storage and the regasification, the FSRD. On the batteries and storage, we have, we're looking on the alternative fuel sources, biofuels, green hydrogen. We look on the circular economy, waste to energy. I guess what we do is what, all the, modern oil and gas companies are doing in order to become, let's say, a multi-energy companies. But I must say the following now, because in this journey, all right, we have to create a strategic plan that is pragmatic and progressive. And what we believe is that in the sustainable energy transition, we mean that there is enough time for the transition towards a more inclusive, effective, more affordable, a more secure, let's say, a global energy system. And this needs to happen without compromising three important things, which one is the security and access of the energy. The other thing, of course, is the environmental sustainability. And the third is the economic development and growth. That is known as the energy triangle. So whatever we do during this energy transition process, we have to make sure basically that we have access and security on the system, as I said, and we have economic development and growth. With this, you can of course put ambitious sustainability targets and an energy transition, but you need to have in your head all the time that you need investment and capital. But at the same time, you need to have the regulation, the political commitment framework has to be there. You need to be able to have stable institutions and governance. You need to have a supporting infrastructure, innovative business environment. You need to have inexpensive technologies and mature technologies. Again, as I said before, for the economic development and growth. And of course, at the end, the ability of the current energy system to accommodate change. So I think that comes when it comes to, this is with regards, let's say, to the environment, what we do and how we see this energy transition in our company. The two things that we also, I just want to discuss about is the social aspect and the governance aspect. So for us, health and safety of our people and our partners and our stakeholders is a top priority. And on the social aspect, we will looking to have a goal zero objective. That means no harm to people, no loss of human life, no incidents, or ruin the company reputation. Okay, so anything to do around quality, health and safety policies and procedures and trainings on our management system, has to be there in order to assure that we have this goal zero objective. On our people side, we try to be an employer that is very responsible. That means that you need to we create basically a working environment that we promote the well-being of our employees with the training, with development, with productivity. We try to support equal opportunities, diversity. And this is something that investors want to see. They just don't want to see only the energy transition and the environmental aspect of our ESG strategy. They also want to say, and this is sort of factors and metrics that the investors and the rating agencies are looking into. So we also pay a lot of attention there. And the last thing, of course, is on the governance side. We try, of course, to follow all the accepted principles with regards to the corporate governance and the latest laws 4706. We have a compliance officer in our group. We look over the regulations with regard to the corporate governance code and the practices and on the international standards and the auditing standards. We're trying to be as much as transparent as we can. Our suppliers, on the supplier side, we're trying to collaborate with suppliers that they share the same values with us. But our suppliers are not big as like we are. So what we want to do is to be able to say to train our suppliers, because they're small companies sometimes. There are SMEs, for instance, that they don't know what is ESG is about, what is sustainability. They don't have sustainability reports. So we're trying to help them to understand what it is in order for them to be aware and for us to be able to say to have this, same values with them. We have this supplier code of conduct that we just developed, and we're trying to incorporate as many as ESG principles in it. And last but not least is our very important action programs with regards to donations and sponsorship, the community contribution program that we have developed, and with very stochastic, I will say, sort of actions with regards to the sustainable development goals, and trying to improve the quality of life, protect the environment, encourage a healthy and social and cultural life. And this is something that we have it, and we we disclose it in order to be able to show that we do give value to our community, our local communities, and we're trying to support that in any means. So this is what we do around ESG and sustainability. Thank you.
Okay, Helena Athosaki, thank you very much for a comprehensive account of what you do at Motor Oil on ESG. Of course, my query is, how do you actually apply ESG? Because Motor Oil, from what I understand, is a major investor throughout the year. I mean, you have some extra projects, but on a current basis, you invest something above 150 million every year on various facets of your operation, improvement, changing of components, training, new facilities for transportation. So when it comes to your investment program, and how do you apply the ESG there? Because do you raise funds separately for investments using ESG criteria, or is this part and parcel of your overall approach to raising funds to invest in your programs?
Yes, thank you for the question. Actually, the way that we raise funds for a specific project has to include ESG, and we're actually happy to include ESG because this is the way we do, as I said before, the ESG impact assessment. So for every project, we'll look at the positive and negative side and how ESG is impactful. Because we have to do it, we also want for us to be able to see whether there's a climate risk there, and also because we know that this is something that for sure is going to be fundable and future-proof. Yeah. There's no doubt that I think even for every company like us in our scale, it will be insane not to include the ESG criteria when do you do a certain investment. In some investments, of course, the ESG criteria have, let's say, it's more impactful, and in some other cases it's less, but it's always there. And we do have a process that we actually follow. And even when it comes to, say, to decide for an investment, that is one of the criteria that we certainly take into consideration. Okay.
All right. Thank you. Before we move to our last two speakers of this session, a question has come in for Mr. Venetsianos, and I will read the question, and then Spiros, you will respond. So the question says, thank you very much for an interesting presentation. Mr. Venetsianos, I agree it's important to include the smaller companies in the sustainability conversation, not just the large ones, but how do you convince them when sometimes it may imply higher costs or a loss of competitiveness for them in the short term compared to less environmentally focused projects? Is this clear?
Yeah, very clear. And actually, this is one of the most common questions that we are getting. Okay. It's spot on because when you think initially, for example, when we approach a hotelier and we tell him, look, we are going to give you an improvement of 20 basis points in your financing if you reduce your energy consumption by 7% per year. The 20 basis points, okay, it's not a big improvement, but they are starting thinking, oh, I'm not even measuring my energy consumption. I need to start measuring it. I need to audit the measurements. I need to discuss with people how much it will cost me to reduce energy consumption and so on. The big topic here is to put it on the agenda. This is step one. If we are all discussing about these things, people will start thinking that it's not only the short-term increase in cost. Yes, because probably our 20 basis points are not going to cover the cost of the investments or the cost of time, but in the future, the company will remain relevant. You cannot avoid it. And this is the message that we are trying to pass. We are trying to educate everyone by putting the topic in the agenda. If you start discussing about it, people will think that they will have a better product if their product is green. They are going to be perceived better by the suppliers, by the clients. by having a more responsible approach. So it's not only the cost, as we bankers tend to think about, the P&L of the current year. It's the long-term impact and how you prepare your company for the future. I hope that I answered the question, but happy to.
I think it was very clear. Okay, thank you very much, Mr. Venetianos. So we move to our last two speakers who go in tandem because they're from the same company and they work together. And we're very happy to have them in our group. First of all, Mr. Shlomi Levy, who is the head of finance of Energean in Israel. Now, Energean is a very dynamic oil company. Now it's oil and gas company, and very soon it's going to be an energy company. From what I know, I have been following Energean since its inception, and we have worked together on a number of projects. And of course, it's very interesting that we have Energean with us today because it shows the transformation of a hard-on oil company into a very environmentally sensitive company. And I'm sure Shlomi Levy and Ehud Lifshitz, who will follow him, will explain this to us better. Right now, one of the biggest operations of Energean is in Israel. They're developing actually some fields with major engineering innovation there, and they will start producing later in the year. And this has taken painstaking efforts to put together a package which is convincing, is environmentally acceptable. And I won't say more. Shlomi, you have the floor.
Yes, thank you. Thank you very much. I'm happy to be here. So thank you for this opportunity. With your permission, I will share some short presentation, which will basically guide us through. So in the next few minutes, I will try to give you some small taste of who we are, where we operate, our ESG credentials and recognition, our strategy and path to net zero, and the financing we launched in 2021 and its correlation to basically to our ESG strategy, to our management team, to our resilient balance sheet, etc. In addition, I'll present to you our energy transition project through our CCS, our carbon capture storage in Prinos in north of Greece. So with further ado, so Energean is a listed company, listed both on LSE in London and TASE on Tel Aviv. We are focusing on gas, mainly in the Mediterranean. You will not see us working in the Gulf of Mexico or Africa. For that regards, we are focusing on ESG, reducing our carbon intensity emission, and targeting our acceleration to net zero. We have strong reserves of approximately 1 billion of oil equivalent according to P. We are introducing and launching next month a new growth campaign, drilling campaign in Israel, most of that which will target one additional 1 billion barrels of oil equivalent. We have strong balance sheet. Our liquidity is around $1 billion, which is allow us to fund all our planned projects. And as we'll discuss also, we have strong cash flow predictability. We expect at the medium term of around $1.4 billion of EBITDA, underpinned by long-term fixed contracts, mostly in Israel and Egypt. So we are operating basically in 8 countries. Our main focus is Israel, which is currently under development, as mentioned earlier, in Egypt, in Italy, and of course in our legacy asset in Greece. With regards to our ESG credentials, so as you can see on the left side of the slide, we decreased dramatically our carbon intensity scope, which was in 2019, given we only had oil production in Prinos of more than 66 kilo of CO2 per barrels of oil equivalent, to a level of less than 8 in 2025, once Israel will be ramped up and on stream. As mentioned earlier, we are focusing on gas. 79% of our weighted portfolio is gas. We have stated, I think we were the first company to state ambition to reach net zero by 2050. We are, and as said earlier by our colleagues, we are linking our executive compensation to ESG goals from 2020. This is disclosed in our annual accounts. And of course, we are committed to transparency and to the 17 UN SDGs. In terms of progress and what we did in 2021 in that regard, so we secured and signed agreements to purchase green electricity for our operated sites in Israel, in Greece, and in Italy. We announced a zero routine flaring policy, which is effective to our entire portfolio. And we will discuss later on our Green Prinos suite of projects, which is basically the CCS and the hydrogen, which we are developing. So in terms of our recognition, as you can see, we received many awards. Energy Transition Strategy of the Year from the Petroleum Economist, Best ESG Energy Growth Strategy for 2021 and 2020. We rated a AA from MSCI. We also rated gold in the Israeli Mala Index. And of course, as mentioned earlier by Elena, we also member of the most sustainable companies in Greece for 2022. As you can see, with regards to our CDP, to the Carbon Disclosure Project, we rate B, which is higher than our sector average, the upstream that we are focusing. And we also rated A- from our supplier engagement from CDP. In terms of our strategy and how we reach to net zero and what we are targeting. So as you can see, we basically mapped our plans into short-term, medium-term, and long-terms, which is basically participating in the Carbon Disclosure Project. We are working extensively to align with the TCFD in terms of our disclosures on our accounts and our financials with regards to ESG. We are increasing our percentage of gas. As you can see, we are close to 80% of gas in our portfolio. We are performing asset optimization. We purchasing electricity, green electricity for our sites in Israel, Greece, and in Italy. And also, not to speak one by one, but as you can see, we're having several projects in place which will take us to net zero, hopefully before 2050. In terms of financing, and the reason at least I'm here. So in 2021, we had a record year of financing. We raised close to $3 billion of secured bonds from the international markets. The majority of that was for our project in Israel. And recently we did $450 million for our corporate bond at Energean PLC. And of course, 100 million euro Greek state loan for our project in Greece. With regards to our financing, so the correlation to the financing as we see it is, of course, demonstrated by very experienced and very tight management team with a strong governance record, our strong balance sheet and cash flow as discussed earlier, but not less important. And we see this issue from many banks and many investors, mainly European, but also Israelis, with our focus on ESG and our carbon reducing emissions. Another thing that I mentioned earlier, we are constantly focusing and working on improving our ESG footprint. We have a clear strategy and goals on how to do and where to do it, which put us in a very good place when approaching the global markets for financing and investment. The $3 billion we raised this year with very attractive coupons comparing our peers in the industry, and the fact in Israel we are not producing yet, it's clearly a demonstration to our basically and support our strategy in terms of ESG, in terms of governance, in terms of our projects, and of course our vision to the future. In terms of our project, our green Prinos, the way we call it in Prinos in North Greece. So we are currently working on developing CCS, a carbon capture storage, in our mature field in Prinos, which is active more than almost 40 years now. This project is qualified for funding from the European Commission's Recovery and Resilience Fund, the RRF. The project, once is on stream in 2025, will be able to inject 1 million ton of CO2 per annum. The project we are expecting pre-FEED in next quarter, basically in April or May this year. First injection is planned in 2025. We are discussing and identified third-party supplies for CO2, like fertilizers, like aluminum plants, and some other stakeholders. In terms of another project that we are working on in terms of our energy transition is the eco hydrogen, which is basically will be able to achieve negative CO2 emissions due to its process and how it's designed. This is the grant is still under basically the IPCEI from the EU, and hopefully we will be able to introduce it on a later stage following our CCS development. So thank you for your attention and listening, and I'll be happy to answer any comments or questions the colleagues or the participants may have.
Okay, so thank you very much, Shlomi, for this all-round presentation about Energean and its path towards sustainability and ESG, using ESG criteria. It's very clear the gradual development of the company from a pure oil company into something more attuned to environmental concerns. And of course, the Israel project is a very big, a very important, big promise, and it will be a very good, excellent demonstration of your work there. So we move now to Mr. Ehud Lifhij. I'm not sure I've said right the name, Lifhij, who works with Shlomi. So Ehud, you have the floor.
So, Kostis, we took the advantage to run it and not to separate this session to two separate parts. So we covered the Energean part, and thank you for this.
Okay. Is this includes Ehud's presentation as well?
Yes, it includes, yeah.
Okay, right. So we can go ahead with questions then. Okay. I think to me, since I've been following the comment, it's very clear what you're doing, but it may not be apparent to many of the in the audience who says, well, an oil company, how an oil company can talk about sustainability, okay? And of course, we've seen the applications towards CO2 capture, CCS, US, which is very important. We see the drive towards gas as compared to oil. So the portfolio will have a lot more gas in the years ahead. And from then we have the possibility of hydrogen developing, so become a major hydrogen producer, and also becoming generating all your electricity from renewables. So this looks well on paper, but I think people, if they are not aware of the technologies involved and the interaction of the technologies, will say, oh, it's greenwashing, okay? So I'm sure you come into this discussion before. So please, can you put your point of view forward with regard or in the context or in the background of this usual, but I believe unfair criticism. So please shoot.
So thank you for that, Kostis. So we are an upstream company. We cannot change our skin or who we are. We are delivering energy. As you clearly mentioned, we matured, we developed from one single asset producer in Greece, which was purely oil, to be an international player that is focusing and having presence in several countries. We are focusing on gas. So so we are not approaching, we're trying not to approach only oil project. We are approaching gas project. We have already reduced our carbon footprint by close to 70%. As I said, in 2019, we were with 66 kilo per BOE of CO2. Now we are less than 18, which is 15% from our guidance, and this is less than the industry average. We are not only focused on the E side of the ESG, of the environmental, which is basically what people are focusing, at least in our industry. We are also very involved in terms of social, in terms of community, of who we are, and also in governance, in terms of our board, our ethos, our beliefs, our responsibility, and the way we actually produce it in a way of developing green projects, in a way that we are linking executive payments to ESG goods, in a way that we're working very hard in terms of reducing our carbon intensity and our carbon footprint. So all of those, I think, are very important to us, not only on the management point of view, but to every employee and to everything that we are doing, because it's important for us also to be, in this era of life, to be attractive to new employees, to young employees that will not see us as, the big bully that is basically the oil and gas companies, the way they see it. So we are showing them that we are moving ahead. We have a clear ESG path and strategy and what to do and how to do it. And we can see it also in terms of our financing. We raised close to $3 billion in bonds only in 2021. And we approached European market, Israeli market, Asian market, US market. And we saw, by the way, the majority of that was from the European investor and banks, that it was very important to them that they will basically invest in a company that it has actually doing in terms of this ESG and its footprint and so on. So,
Shlomi, I have a question for you. It has just come in from Mr. Chrysovalandis from Mikromatis from DNV. And the question is, can you please tell us more about your hydrogen project?
So our hydrogen project will be introduced also in the Pre-Issuance area where we are working. So we are trying to basically to develop green projects in mature oil and gas fields. So at the moment we are focusing in Greece, but we are also exploring Italy. We are also exploring Israel. This hydrogen project will basically it's basically very on the evaluation stages. We are seeking government approvals. We are seeking permits. Those things will take few years till they will be mature. And this will be in line with our CCS project. So it will be basically at the same area and the neighborhood from around us in terms of fertilizers, in terms of aluminum factories and some other companies that basically have those CO2 in terms of ammonia, in terms of everything else will be basically taken into account in that project. But again, we will first introduce the CCS project that was already qualified for funding from the European RRF, and hopefully the field and the project will kick in very soon.
Oh, so CCUS is very central to your gradual sort of move towards hydrogen. Is that right?
Yes.
Okay. So thank you very much both for this very interesting high-tech presentation. And I think we have a few minutes. If there are any questions from the floor, we have all our speakers here. So this is a good opportunity to put forward your questions. I do not see any questions in the chat room, but maybe some of the speakers present have questions for other speakers. No? Okay, so I suggest that we bring this session to a close. We'll go out for a short break, 5 to 10 minutes most. There is a question. Okay, let's see, where is the question? Yes. Does sustainable financing with ESG criteria increases the cost on the operation? So on the operation of the operations, if it does, how can this become profitable? So I think this is a question addressed to everybody around the table. I repeat this: do sustainable financing with ESG criteria increase the cost of investment operation, and how investments can become profitable? So some of you would like to answer this question? Shlomi, okay, go ahead.
So from our perspective and the way we see it, because we are a long-term player. So when you look not on just on the next 1, 2, or 3 years, and you look on the 10, 15, and 20 years, including your growth and your expectation. So no, I expect that the opposite will come around, and basically it will reduce your operation cost when you will look at it on it as our overall.
Okay. Somebody else like to comment on this?
I would like to comment as well. I think Shlomi is right. Yeah. I think that actually it's the opposite. And I wouldn't say in the long term, I would say in the short term. If you apply ESG criteria in a correct way, if you know exactly where to target, what to actually embed into your strategy, what is important and material for your company, then will definitely create a competitive advantage, and it will definitely improve the cost, basically. So I think the earlier, the better. And I think now we have much more information, even for the small companies, to understand exactly what ESG criteria they should actually involve into their business. So they shouldn't actually see it as a burden, but I think that they should see it as an opportunity.
Okay, thank you very much. That was a very good point. Thank you. Somebody else? Okay.
I think it was covered by the previous.
Spiros, yeah.
The issue is whether you see the cost on the short term or the long term benefit of this investment. So I think if somebody is focusing on the long term, then I think the benefit is there.
Okay. Right. So thank you all very much. We now go for a break, and 5:30 we start our next session, and Vasilis Rallis will be the moderator. Thank you all again, and we will be in touch very soon.
Thank you.
Of today's very interesting event, I have to tell that the previous session was extremely interesting because I think we got to understand what's going on both from the industry's point of view in terms of what exactly is ESG and what will be happening. And at the same time, we were able to understand the point of view from Mr. Veneziano's really insightful presentation of how banks value risk on what is considered to be, let's say, investing with those criteria, with the ESG criteria. And one of the things that we will be looking at in this last session of today's event is exactly how we will be able to financing some of those investments, and in particular the green bonds. And we have three very interesting presentations to let us know their insights on how we should be able to capitalize on that. And I would therefore ask the ladies first, Ms. Irene Terzidiou, our research fellow at IENE, to give us her views on what we'll be discussing about green bonds. Mr. Terzidiou, the floor is yours.
Hello, thank you, Mr. Alice. Just a moment to share my screen. Can you see my screen? Okay. Hello to everyone. I'm very glad to be here on this workshop. I'm Irene Terzidiou, IENE Research Fellow. I will start my presentation with the investment needs in the climate and the energy sector, and thus the capital flows needed to tackle climate change and to meet Paris Agreement goals. And then I will continue with the green bonds. Getting on track for net zero emissions in 2050 means deploying commercially available abatement technologies in each sector this decade. More than 3/4 of the effort to cut emissions in the next 9 years falls to the power sector and to the faster deployment of wind and solar PV. Another 40% is achieved with greater use of electricity in transport, in heating for buildings, and in providing lower temperature heating industry. Also, greater recycling in steel, aluminum, and plastics account for a 2% drop in emissions. This is an analysis from Bloomberg New Energy Finance, which shows that global energy-related emissions need to drop 30% below 2019 levels by 2030 and 75% by 2040 to reach net zero in 2050. That implies 3.2% emission reduction each year to reach to 2030, which is a reversal to the trend we observed until now, which is 0.9% emissions increase a year from 2015 to 2020. The figures you see are the milestones needed to be achieved by 2030 and 2050, so as the world to be on track in the mid-century. The power sector needs to make the greatest progress over the next decade. Electrification also plays an important role. And all these figures are based on the green scenario, where green hydrogen complements electricity use, recycling, and bioenergy. And so fossil fuels are 10% of primary energy, renewables 85%, and nuclear 5% in 2050. All this I said were based on scenarios and require a huge amount of money. But what is the situation now? As we can see from the diagram, climate investments have steadily increased in the last decade, reaching around 600 billion in 2019-20. But flows largely remained the same in the last few years. The increase between 2017-18 and 2019-20 was only 10%, much lower than the previous period where the capital grew more than 24%. I just wanted to clarify that the climate flows refer to mitigation and adaptation investments. When mitigation means making the impact of climate change less severe by preventing or reducing the emissions of greenhouse gases, and adaptation is the process of adjusting to the current and future effects of climate change. So climate finance flows are nowhere near the estimated needs. In this diagram, we see the average estimated annual climate investment need through 2050. So to achieve the transition to a sustainable world, climate investments must increase from current levels, as we saw and as we see from the bottom of the diagram on the left, and we saw in the previous diagram, from around 600 billions to around 4 trillion annually by 2030, and to 5 to 6 trillion by 2050. It is important to mention that the gap between today's investment trends and a sustainable pathway is larger in emerging and developing economies. When referring to the energy sector, the International Energy Agency estimates that for the net zero emission scenario, the total energy sector capital spending must be increased from around 2.5% of GDP per year to around 4.5% of GDP in 2030. By 2030, as we can see from the diagram, the vast majority of investment goes towards clean energy technologies, of which the largest share is for power generation, with total annual investment increasing from 0.5 trillion to around 1.7 trillion in 2030. The increase is also significant in transport, where the purchase of electric vehicles drives up spending. There are different estimates for the investment needs. So a recent study from McKinsey and the Network for Greening and Financial System suggests that the capital spending on physical assets for energy and land use systems will need to rise to an annual total of 9.2 trillion to reach net zero by 2050. International Renewable Energy Agency, IRENA, has estimated that the deployment of energy transition related technologies required to put the world on a 1.5 degrees Celsius pathway necessitates 131 trillion of aggregate investment. This represents an annual funding requirement for the energy sector of about 4.4 trillion between 2021 and 2050. When the current situation shows 3.3 trillion per year, and increase funding share of fossil fuels and nuclear. Now, when we refer to the renewables, the global energy transition requires a massive scale-up of renewable energy investment, and the allocation of capital flows away from fossil fuels. IRENA estimates that to put the world on a track with the objectives of Paris Agreement, annual investment in renewable need to be considerably higher and increase from current level of 300 billion to reach 800 billion by 2050. To evidence the acceleration of renewable energy investment, I include the diagram below, which shows that wind and solar PV installed capacity for power generation in European Union has increased over the last 10 years, while combustion fuel registered a considerable decline in their capacity, still hold a high share. This graph shows that the current level of renewable energy investment, around $300 billion, is insufficient to put the world on a 1.5 degrees Celsius trajectory by 2050. It needs to at least triple, based on different scenarios from different sources, like Bloomberg New Energy Finance, IEA, the National Energy Agency, and IRENA. Annual investment ranging between 100 billion and 1.9 trillion is needed over the period through 2050. For European Union to transition to a climate neutral economy and to reach its environmental objectives, significant investment is required. The European Commission estimates that the achievement of the 2030 EU's climate and energy targets, a 55% cut in greenhouse gas emissions compared to 1990 levels, and at least 40% share of renewables in final energy consumption, would require in the period 2021-2030 energy system investments of 336 billion per year, which is equivalent to 2.3% of GDP. Overall, we got a picture of the investment needs for clear energy projects and the huge amount of capital required to tackle climate change. So now I will present an instrument that is gaining a large momentum in the last years as a tool to finance green projects, and that is green bonds. Green bonds is a transparent way of channeling private capital into sustainable investments. So the bond market can facilitate green transition. Although there is no universally agreed definition for these instruments, you can see in this slide examples of similar definitions coming from institutions working on this field, like the International Capital Market Association, the World Bank, which was one of the first institutions to issue green bond back in 2008, and more recently, the European Commission. In a very simple way, a green bond is a fixed income debt instrument that uses the proceeds derived from the sale of the bond to exclusively finance or refinance green projects. When issuers sell green bonds, they are making a commitment to earmark the sales proceeds for environmental friendly projects. Green bonds are structurally the same with traditional bonds. The key differentiation between a green bond and a conventional bond is the project that is financed with the proceeds. Green bonds, as we said, are issued exclusively to finance projects that positively impact the environment. On the other hand, conventional bonds are primarily issued to finance general projects with general purposes or refinance existing debt. There are different types of thematic or labeled bonds, as we call them. We have green bonds, climate bonds, social bonds, sustainability bonds, transition bonds. So as we said before, a bond is labeled green, where the proceeds from the bond are dedicated to projects or assets with environmental benefits. Social bonds finance projects with social impact, like affordable housing, access to infrastructure, access to health and education. Sustainability bond is financing a range of social and environmental projects. Transition bonds are designed to allow how emitters to fund the receive towards cleaner, more sustainable operations like the oil and gas companies. We have also other types of bonds like the pandemic bonds emerged in 2020 to finance projects that support the recovery of COVID-19. Catastrophe bonds and blue bonds where the proceeds are used to finance marine and coastal projects. We are going to focus on the green bonds, which can be considered the most mature instrument in the market. Green social and sustainability bonds, collectively referred to as sustainable bonds. These bonds are use of proceed bonds. They share similar traits and are fixed income debt instruments. As opposed to green bonds, sustainability-linked bonds are performance-based debt instruments linked to the issuer's achievement of climate goals or broader sustainable development bonds. Sustainability-linked bond comes with no restrictions on how the proceeds can be used. Issuers of sustainability-linked bonds pledge to improve their performance against key performance indicators. And for example, the Greek Public Power Corporation has issued a 650 million sustainability-linked bond with a commitment to reduce CO2 emissions by 40% until 2023. Green social and sustainability bonds align with the 4 core components of green bond principles. The International Capital Market Association has formulated these principles, which are use of proceeds, process for project evaluation and selection, management of proceeds, and reporting. I'm going now to the market overview. The green bond market has seen exponential growth. We see a growth rate of over 50% in the last 5 years. By December 2020, the market surpassed the cumulative milestone of $1 trillion. And at the end of 2029, the market registered $1.5 trillion in labeled green issuance. Regarding only green bonds issuances, we can see from the diagram below the 2020 record figure of 297 billion was overtaken in 2021, surpassing $500 billion. And the forecast from Climate Bond Initiative for the end of 2022 or early 2023 is to reach 1 trillion in a single year. Okay, the green bond has seen exponential growth, but despite this trend, green bonds remain a fraction of the overall bond market, representing about 3.5% of overall bond issuance. Now the countries, Europe was the dominant region for green debt in 2020 and also in first half of 2021. As we can see from the diagram above, Europe was the dominant region over the years. For 2021, the USA and Germany maintained their leading first and second position as of 2020. France moved to the 4th position, while China took the 3rd position. In Europe, green bond issuance reached $690.4 billion in 2020. The first country in issuance was France, followed by Germany, the Netherlands, and Sweden. Greece has issued green bonds of a total value of $1.5 billion. And now, which projects can be financed with green bonds? The climate bond taxonomy identifies the assets and projects needed to deliver a low carbon economy, and the sector criteria contains the requirements that specify what assets and infrastructure can be financed with bonds. So projects that can be financed fall into the renewable energy category, clean transportation, clean water, green buildings, land use, and marine resources, and sustainable waste management. Regarding the use of proceeds breakdown, investment in the energy sector and for 2021, investment in the energy sector and specifically in renewable energy comprised the largest share of issuance by 35%, followed by investments in low carbon buildings and transport. Who can issue a green bond? Private companies, financial institutions, municipalities, and national governments. In September 2020, the European Commission announced its intention to raise 30% of the Next Generation EU fund through the issuance of green bonds and use the proceeds to finance Greece's investments and reforms. After adopting an independently evaluated green bond framework, the Commission proceeded with the issuance of the first Next Generation green bond in October 2021. The Commission issued a 12 billion bond, euro, which is the world's largest green bond today. For Greece, large companies like Terna, Ellaktor, Mytilineos have already issued green bonds to finance the renewable projects. Also, banks take part in the green bond market, with National Bank of Greece and Piraeus Bank to have issued green bonds. Moreover, the Greek government prepares to issue green bond, a green state bond in 2022. Now, to issue a green bond, in addition to the conventional bond issuance process, there are some complementary steps to follow. It is important to clarify that from a financial perspective, the process of issuing a green bond or another thematic bond is the same as of issuing a traditional bond or a vanilla bond, as it's also so called. We have in the pre-issuance phase, there are two additional steps: defining a green bond framework and the search for supporting mechanism. In the issuance phase, it's important to include the green attributes in marketing materials in order to attract a broader pool of investors. And in the post-issuance phase, issuers must allocate the proceeds to the eligible projects. They need to track these proceeds and provide reports on this and perform an audit if necessary. When issuing a green bond, there are different types of external reviews to be undertaken. Issuers appoint external review providers to assess the green attributes of the bond and to confirm the alignment of bond with the components of the green bond principles or the climate bond standard requirements. We have the assurance methodology, which is a positive or negative assurance on compliance with the green bond principles. The second party opinion, which provides an opinion on the framework and the issuer's sustainability. The green bond rating, which scores the issuer's framework against an established range. And the certification, which is a third-party verification, confirming that the use of proceeds adhere to the climate bond standard and sector-specific criteria. In the case of certification, the certification process is taking place in accordance with the requirements of the climate bond standard version 3, you can see on the left. There is also a proposal for a European green bond standard, which is not yet approved. This is a part of the European Green Deal. Now, if an issuer wants to be certified against the requirements of the climate bond standard, the certification process can be separated into two distinctive phases: pre-issuance certification. This comprises steps 1, 2, and 3, and post-issuance certification, which relates to steps 4 and 5. The first step is to prepare the bond. Pre-issuance certification focuses on selection of eligible projects and assets, and have to be in line with the sector criteria.
Yeah, Mr. Zidou, we conclude because we're running out of time.
Yes.
Thank you.
Then the green bond framework is created, and verifier is engaged so as to provide the verification report. The post-issuance certification step. In this step, the verifier prepares the post-issuance report, and it is submitted to the Climate Bond Initiative and receives the post-issuance certification. And finally, I would like to highlight that IENE is an approved verifier since January 2021. It can undertake the whole certification process for an issuer to be certified according to the requirements of the climate bond standard. That's all I would like to say. Thank you very much for your time and attention.
Thank you, Mr. Zidou, for the presentation. I think we can all agree that green bonds are here to stay. You've given us quite an overview of the European and global and actually and the Greek market, as it were, of what's going on. So we now have an understanding of what's going on in the market. And I think it's time to move on to the more practical things of how to issue and why an investor should choose a green bond. And I would ask Ms. George Kofinakis, who is the Senior Advisor and Managing Director of Safe Harbor, a securities company in the UK, to give us his thoughts on why would an investor go for a green bond or rather a traditional one.
Yeah, good afternoon. There was a very explicit presentation from Mr. Zidou about green bonds. What I would like basically to cover is how investors are benefiting in investing to green bonds, and especially with their interest rates and potential credit risks that green bonds may inherit. Investors are increasingly demanding socially responsible investment opportunities and have expressed a strong appetite for green bonds by repeatedly oversubscribing issuances in the last few years. So basically, green bonds provide to institutional investors with means of accessing sustainable investments in the fixed income market in a familiar low-risk vehicle. That was not the case a few years ago. So the primary benefit for an investor is that green bonds are transforming financial services and the way the participants do business. They promote greater transparency because basically you have to issue an annual report on the progress and the impact of correlated green bond subject. And this transparency helps both the issuer, but mainly the investor in the use of the funds and to the evaluation of the impact of the green bond. Transparency also furnishes higher comfort to investors that are willing to pay a small premium versus a plain vanilla bond. So in addition, transparency also helps the credit profile of the issuer because you can see what exactly the actions and the deployment of the investment by the company is been doing on an annual basis at least. That's not very regular on plain vanilla bonds. In addition, green bonds provide investors with a chance to brand themselves as forward-thinking, innovative, and sustainable. The press continues to cover green bonds issues very favorably. And marketing-wise for investors, this is a very, I would say, perfect free tool. So despite those quantitative, if we say, criteria, we have some qualitative criteria that are attracting investors on green bonds. And the big difference between vanilla bonds and green bonds lies in climate risk management, both from a corporate and portfolio perspective. Climate risks are investment risks, according to BlackRock's CEO, Larry Fink, in a recent letter that he shared with his shareholders. So the fiscal risks of climate change will determine which issuers and financial players are the least exposed to climate risk. So that's vital for future investments on avoiding climate risk potential. For example, what happens to inflation and in turn to interest rates if the cost of food climbs from drought or flooding? How can we model economic growth if emerging markets see their productivity decline due to extreme heat and other climate impacts? This will be a decisive factor for debt market players seeking to finance activities in the short and long term. These questions are driving a profound reassessment of risk and asset values. And because capital markets pull future risk forward, we will see changes in capital allocation more quickly than we see changes to the climate itself. And in the near future, I believe, and sooner than most of us anticipate, there will be a significant reallocation of capital towards climate sustainability and effectively to green bonds. And when we mentioning green bonds, we don't specify only bonds as such. It can be any lending opportunity that and form that can provide the finance in the financial market. So basically, it can be loans, it can be securitization, it can be commercial papers, any kind of lending form. To that extent, I believe for investors, green bonds remain and will attract more and more interest in the near future and much faster than what we are expecting to.
Thank you very much for this. I have only sort of one question based on your experience, which is, what would you think that an investor would be sort of prepared to pay as a premium, so to speak, to get that bond?
Right. Yeah, there is that terminology of greenium in recent years, and basically the greenium in its purest sense is the price difference between green and non-green bonds. And effectively, we have seen a lower yield in green bonds and a higher price than the plain vanilla bonds. And why is that happening? From what I said before, there is already a huge oversubscription for green bonds, and the supply is rather limited compared to the global demand. And that gives the opportunity for a better pricing in green bonds. So effectively, a green bond, a greenium, is nothing else that differentiates from a green bond from a plain vanilla bond, but just the price and the yield difference that is in favor to the green bond. Everything else, like coupon, maturity, size, issue date, etc., and even currency, can be equal. So if green bonds command a premium, it must reflect the prevalence of demand over supply. And the issuance of green bonds has soared, as I said before, and outstripped the demand. So the so-called greenium reflects this through the lower yield and the higher price. To this oversubscription, we have also seen appetite from led many firms such as Standard & Poor's, Bank of America, Barclays, MSCI to launch green bond indices just because the demand is picking up on this front. And lastly, more and more supranationals such as EIF, EIB, BRD are willing to rebate to the issuers a part of the interest rate cost due to the ESG nature of the green bond. I have personally issued a green bond, quote, green bond for a Greek company here, Autolis company, 2 years ago. And the whole bond issue was placed to supranationals like EIB, BRD, KfW, with the guarantee of EIF. And there was an element that as long as the company will be investing more and on a specific percentage to electric cars, hybrids, and low carbon cars, they were getting a 50 basis point rebate, which was quite vital. If you imagine that the bond issue at that moment, it was at 225. So the effective rate for the company, it was 175 because of the rebate. I believe I have covered it.
Yes, you have. Thank you very much, Profanagos. It was quite sort of refreshing to hear what exactly is going on. And you touched on several subjects. And one I think that our next speaker will be most sort of expert to give us his thoughts is about the supply and demand of green bonds and how they affect the market. And therefore, I would like to welcome Mr. Sean Kidney from the Climate Bond Initiative, which is an international NGO trying to mobilize global capital. Is that correct?
Vasilis, that's correct. You've got it in one.
Thank you very much.
Look, Irene and George have covered the territory very well. So they've covered my talk, which is fantastic. You know, I think what you've heard from Irene and George is this is an extraordinary market. This is an unbelievably exciting market. We have the growth like a bullet. This market has grown 80%, sorry, has grown in some countries 100% last year, will grow 80% this year. We're currently at about $1.7 trillion outstanding globally. When I started 10 years ago, we were about $1.6 billion outstanding. That is extraordinary growth. And that growth shows no sign of stopping. We're working on the basis we're going to see $5 trillion a year of green bonds in 2025. We kind of need to. If they're going to contribute adequately to this incredible challenge we face to address climate change, we need that level of capital flow. We simply can't do what we need to do without seeing those kinds of deals moving. In a report that McKinsey's put out recently, they talked about an annual capital flow to address climate change of about $9.2 trillion. In fact, they're underestimating because they haven't adequately addressed resilience, the kind of things that we need to do to ensure we're better protected from fires or water scarcity and so on, or heat incidents, which is going to become a problem in Athens again in summer. We need to prepare as well. So the overall flow is about 10 trillion. But we are lucky, it's a funny thing to say, as we look at the spectre of climate change, We are lucky because we have a savings glut at the moment. We have managed to create institutions in the last 30 years that are very good at bringing together pools of capital, pension funds, insurance funds, sovereign wealth funds. That is a success for macroeconomics. Perhaps one of the few, but anyway, a success. That money has to go somewhere. At the moment, it's going to places where it doesn't necessarily want to go, like the oil and gas industry, but it has to go somewhere. What we find is whenever we do something that is green, that also addresses their risk yield requirements, as George says, oversubscription goes whoosh, double the rate of any vanilla bond. In the secondary market, when we see trading in green bonds, they hold their value whenever there's a downturn. So if Donald Trump sends out a terrible tweet, the market crashes, green bonds hold their value. Now, there's a famous quote by Larry Fink, the head of BlackRock, who said he made money not by giving investors yield, but by making sure they didn't lose their money. Investors are fundamentally defensive in the fixed income space. Now, we have here a product which is perfect for ensuring that you can maintain the value of your portfolio. So as a result, we have a lot of investors who participate in this who don't care a lot about the green. They just care about the value retention characteristics of the instrument. These are the things that are driving demand and are driving that better price difference that George talked about at primary for initial dealers. That's what's exciting. And it's not just in euros or dollars. I was on a panel with the deputy mayor of Moscow a few months ago. Weird to think, given the tensions in the Ukraine now. But anyway, he told me that they issued a $700 million green bond in rubles, not in dollars, in rubles equivalent. And they got a 20 basis points advantage over the vanilla issuance in Russian rubles. This is not euros. This is not some fancy French investor here. This is mums and dads and institutional investors in the heart of Russia. We see the same thing in Egypt, the same thing in ASEAN, the same thing in Chile. It is a global phenomenon. And I think George put it was right on the button, I should say, when he said that this is about identifying investments that are lower risk, investments that are preferential going forward. What we now see, and this is perhaps the most exciting thing about this market. 10 years ago when I started, people were still in the wake of the Nicholas Stern report. Everyone said to me, well, green is great. We've got to go green, but it's going to cost us extra, right? It's going to cost us 1% or 2% extra, which is hard because no one's got 1 or 2%, but, okay, we'll work at it. And so everyone thought it's going to be a small market. Now, investors look at green bonds and green investments, and those investments that are part of the taxonomy, the European taxonomy, the climate bonds taxonomy that drives certification, and they think this is a lower risk universe. This is a safer universe. Why? Because these investments are less likely to be impacted by climate change or policy change. As a result of the Biden climate summit in April earlier last year, every major Western economy has now committed to strong 2030 targets. I cannot find an investor in the world who does not believe change is a coming. What they're trying to figure out is how to surf the wave to stay ahead of the change. They know it's happening. We've already seen some disruptive policy changes. In 2001, the German government introduced the feed-in tariff, copied by other countries in Europe. In 2006, the Chinese government embarked on the largest solar and wind energy procurement drive in history. And those two initiatives, large-scale offtake agreements, drove down the price of solar. Now solar is dirt cheap. I'm getting price forecasts from Saudi Arabia and India and Chile, which are 1 cent a kilowatt hour. This is just unbelievable compared to where it was. And of course, we now have a revolution happening in energy, in green hydrogen, and many other areas because of this. That's a policy change. That was created by policy. Now, if you think that every country is now looking for what they can do, what else are they going to do? How do we keep ahead of this? That's what investors are worried about. And that's why they like the green flavour. It's not just bonds, by the way, green loans, green equity now. There's all sorts of things that are beginning to appear using the same idea. Of course, governments are now trying to push it to say, great, I can get my stuff funded without having to tax George, increase his tax rate. So we've got the taxonomy, we've got disclosure arrangements, we've got green quantitative easing by the European Central Bank. In China, at the central bank, if you're a bank like Piraeus Bank and you put in green bonds as collateral at the liquidity lending window of the central bank, you get a 1% discount on funds. That is pretty cool. We need this in Europe too. Someone's got to say to the ECB that there are many incentives coming in all over the place. So governments are taking something which is working and realizing if they push a bit further, they can grow it much larger. We will see this year a wide range of risk mitigation support mechanisms by richer countries to grow green bond issuance around the world that meets taxonomy and climate change requirements. This is the next stage of growth. So it's pretty exciting. Of course, the most exciting movement for me lately has been sovereign issuance. You know, we've seen crazy rates. The German government, when they put their green bond out, they got a 2 basis points benefit at negative interest rates. We pay them to take our money at the moment, and we pay them more if it's green. But that price benefit they got was then repeated by the UK, by the Netherlands, by France, by the European Commission, and the Danes, when they put out their AAA bond, got 5 basis points. The Egyptians did one too. Their bond is tracking 75 basis points advantage in the secondary market, and so on, and so on, and so on. Greece, where are you? We need you. It's an exciting time. I'm looking forward to a lot more coming out of Greece in the next few years. I mean, we've seen, of course, 6 bonds, 7 bonds, I think George was telling me a minute ago already. We need to see 70, 75. So work to be done, friends. Work to be done.
I think we have some traction in that market in Greece because we looking at, starting from basically scratch and moving up to $1.5 billion, something like that. And therefore, I'm quite, optimistic about how that market will go and how those bonds will, spread around, so to speak. Okay. Quite interesting, Sean, what you just told us about supply and demand. I think we are reaching at the end of our session, which was very, very interesting in terms of what Irene, George, and Sean discussed. Are there any questions that people would like to ask our 3 panelists around here?
I'll just add some. Sorry, the echo there. I'll just add something, Vasilis. The next stage, the thing we now need to develop is the tough stuff. This is what we call transition investments. This is taking high carbon like cement or chemicals and so on and transforming those industries to become low carbon quickly. We will later this year roll out what we call entity certification. If a chemical company has a corporate strategy that will lead to substantially reduced emissions in an appropriately ambitious timeframe, we will certify the company and their strategy subject to annual reporting. That will not only mean that all their debt spun off can be green, but also they might get a green tick on the stock exchange listing and access, of course, to other kinds of incentives around. This whole area of green is now expanding to different kinds of instruments, different kinds of mechanisms going forward. I certainly hope that the Institute will be a central part of growing that market in Greece and organizing certifications. But I want to stress that we have a lot to do to understand how much we've got to do. It's not just clean energy. It's not just transport. It's not just water. It's also about the nature of agriculture. How can we change agriculture to be more resilient to the increased temperatures we're getting and the lack of water that's being, but also to sequester carbon? One of the great hopes of climate change is that soils can be used to capture more carbon and bury it. Well, that requires us to think about different crops and to think about different kinds of additives to soils and so on. What are we doing in industrials? What are we doing with the ports? Is Piraeus appropriately resilient to the kind of sea level rises that are going to start coming through faster and faster and faster? What sort of investments are required there? It affects every corner of the economy. And that's the real thing that I want people to think about out of here. It's not just a few corners of the economy. Of course, green bonds are just a simple symbol that we're doing something that have benefits for the issuer. Stock price bounces, all these sorts of things. But fundamentally, what we need to do is to colour in our cities with the stuff that is green, label the metro in Athens and say that is a climate change investment, maybe a useful metro as well. We need to know what the right things are and make sure we stop doing the things that are not the right things. And that's tough. And we've got a very short period to do this. Our European, our global emissions need to be cut 55% by 2030. That's a few short years away. They went up 16% last year and about post-COVID. We've got our work cut out for us. By the way. Indeed. So anyway, apologies, Vasilis, I can rant, but I just want to say there's a lot of work to be done. We need to get the bond issuance out to get the market going and to draw attention to it. And through this, I think we can mobilise the capital that Greece needs.
Thank you very much, Sean. Thank you, George, and thank you, Irene, for a very interesting session. And I'll pass, Kostis, the floor to you for the next round of sessions.
Well, first of all, I'd like to thank everybody on this session for their very enlightening presence, and especially Sean, who I see for the first time, but with whom we have corresponded, and he's the driving force behind the Climate Bond Initiative. And I'd like to say how happy we are that we are working with Climate Bond. It took us some time to get approved, but that's okay. I think it was a very interesting and process. We learned a lot in this process, and but now you see we have to sell bonds, and this is where the difficulties start. And thank you very much for accepting to participate in this on-round meeting. We married ESG and green bonds because we think it's part of the same discussion. And as we're trying to develop the green bond market in Greece with the help and close relationship with the Climate Bond Initiative, I think we have to build on present experience, which is really ESG. So as you probably gathered, an ESG culture is already in the offing here. So that's very good for us because we are talking to the initiated. Green bonds is, as we see it, a step further, a step up. And the market is fairly small, but we are working on this. And it's not something that you can sell like you sell other interesting financial products. It's a more valuable, as we see it, is a more valuable product. And so therefore you have also to devote a lot of your valuable time trying to explain this to prospective clients and beneficiaries. So Son, you presented the global picture very well, and I think that was very useful because not many people realize the magnitude of the market and the impact that such a market can have on a betterment of environment and the globe as a whole. But also the other two speakers were very useful because they filled in holes, very specific holes in our understanding and knowledge. So we will try and carry on this relationship. We'll try to have such type of meetings once in a while. We find them very useful. Now that we have made all the introductions, I'm sure we can go to the next level and actually talk more specifics. And because companies want that. I mean, there is a demand by companies to go into green bonds, but they are they want very specific information. And all this will come out through interaction with Climate Bond, with practitioners like George, like Vasilis, who are in tune, they are in the market, they are talking every day to investors and to companies. And we, from our side as an institute, verified with Green Bond Initiative, will be there to provide the technical assistance and the facilitate the process of issuing a green bond. So I have nothing else to add, just to thank everybody also from the first session. I see many of them are with us still. And we are at your disposal. If you visit our website, we have already explained our interest in green bonds, give some very fundamental information. It links with Green Bond Initiative, Climate Bond Initiative in London. So it's linked. You can see through what we do, also what the Climate Bond Initiative is doing. And of course, we like to help in establishing climate bond as a standard for the issuance of green bonds in Greece. I mean, this is an immediate and undisputable target of us to establish Climate Bond Initiative as the standard in this part of the world. So once again, big thank. We'll come back to you with information on this and other events, and we look forward to welcome you again in one of our future conferences, webinars, hybrids, whatever you call it, and hopefully very soon we'll have something live in Athens before the end of the year or next year. So with this thought, I'd like to say good night and to you and everybody. Bye-bye.
Thank you.
Bye-bye, son.